Hi, you're listening to What's the Deal, our investment banking series here on JP Morgan's Making Sense podcast. I'm your host, Evan Junick from JP Morgan's Corporate Finance Advisory Team, and today we're diving into recent developments in the UK and EMEA M&A markets with James Robinson, head of UK and Ireland M&A, and Dwayne Lysett, head of EMEA M&A here at JP Morgan. James and Dwayne, amazing to have you on the podcast today. Love to have you talk about yourselves for just a minute. What brought you to JP Morgan and your roles here? James, why don't you go first, and Dwayne, you'll follow up.
Sure. Evan, thank you very much for having us. So I'm a JP Morgan lifer. It's interesting. We've got our new batch of interns for the summer, and I really enjoyed my internship at JP Morgan back in 2003, and then realized that that was the same as someone coming up to me and saying, hey, I remember doing my internship in 1984. I actually originally started up in TMT coverage, and I've been in UK M&A since 2010, so that's 14 years now.
Amazing. And Dwayne?
Thanks, Evan. This is my 28th year at JP Morgan. I'm from Dublin, started as an analyst, actually in UK M&A during the summer of 96, and I haven't moved very far from that. So looking after me M&A, but I probably still do 70-80% of my business in the UK and Ireland.
Awesome. Well, that makes 3 JP Morgan lifers here on the podcast today. Why don't we just jump right into it? The UK M&A market has had a pretty phenomenal start to 2024. James, can you walk us through some of the key drivers behind the trends you're seeing?
It's been very good. The summer of 2023, from a market activity perspective, was definitely one of the quietest we've ever seen. There was certainly a lot of upside. We surpassed deal volumes in 2024 in excess of the entirety of last year. I think there's probably a few buckets driving this. The biggest one is just an increase in animal spirits. Boards and investment committees just feeling a bit more positive. There was a little bit of a dislocation in the financing markets that's normalized. That has just sort of led to an increase in people wanting to do transactions. To answer the question on why specifically in the UK, because I think these are certainly themes that we've sort of seen globally, there's a few specifically to us. The UK equity markets, certainly for sort of UK mid-cap companies, are not a particularly cheery place from a valuation perspective. But what we're really seeing is a real dislocation between fundamental value of some of our fantastic, maybe smaller mid-cap, that sort of $1 to $2 billion transaction mark companies, and what the screen prices are. That's really building overseas sort of appetite and interest, and particularly from the US, to come and cherry pick some of our family silver. The other one is just global strategics. Confidence is returning. The cost inflation and lower growth in mature industries are forcing a number of our companies to just find scale through M&A as well. And then I think the final one is sort of financial sponsors. And we've really seen them sort of start to come out the gates, particularly in the P2P space, really being opportunistic about some of the dislocation in values that we're seeing in the UK equity markets. And then I think the real kicker for next year is, sponsors have a large number of big private assets that they bought back in 2021, high quality, that at some point they are going to need to test the water. They are going to need to get these secondary sales out into the market. We've certainly got a lot in the hopper, and we're just waiting for that first one out of the gates.
I think that's really interesting. A couple points I would just reiterate in your comments. I think first, that theme of scale is one we're actually seeing quite globally. The economies of scale and the pricing power that many larger companies have in the context of the inflationary trends. I think that's clearly a noteworthy theme that we see resonating around the world. Dwayne, over to you. Love to hear a little bit more about the parallels or lack thereof that you see in the broader pan-European M&A trends that you cover.
I'd probably underscore James's points. Confidence drives M&A globally. We've definitely seen things, I think, settle down. You mentioned, Evan, inflation very much under control. We sense interest rates reacting to that. The sense is that while they may stay high for longer, they're probably going to drift down. And I think that gives line of sight. That confidence factor is coming back. And our sense now is that it's kind of started and the momentum within reason is continuing, or it's building, which gives us strong hope for H2 and really into 25, 26 and 27. Private equity, it's coming back. We're seeing them do P2Ps, so public to private transactions across the EMEA market, primarily in the UK. We are seeing them now starting to launch sell-side processes, a bit of competition in there, often leading with quality assets, and that is starting to come back. And then the strategics, as James highlighted. In some ways, I think they're kind of stealing a march on the threat that private equity will indeed come back and come back quite strongly. So getting those deals done. But a lot of those are equity for equity transactions, cross-border, the deals we've known for many years that should happen because strategically they're the right transactions. And often, as well you know, Evan, it just takes the stars to align, whether it's around value, whether it could be the social aspects of the senior executive positions, all of those things. So we're getting a number of those transactions coming through. And I think in EMEA, what we're seeing globally, it's led generally, as we know, by North America. But the overall volume is being led by the large transactions, the $5 and $10 billion plus deals, which have come back in force. And I'm glad to say that we've had a number of those transactions, particularly in the UK and Ireland. I'm glad to say that we're on quite a number of them, which is even better. But for me, as I look across the EMEA business, the UK and Ireland is the bellwether. It generally is a business which can mark anywhere between, on any one year, 30 to 50% of EMEA volume. So when the UK and Ireland is powering up, it gives a very positive message across the continent, and hopefully we'll see that reflected more widely in the business.
Dwayne, do you think it's a fair comment that in each cycle, and we've seen a few cycles between us on the way up and on the way down, the UK does tend to be in the vanguard, and where the UK and Ireland lead, the rest of Europe tends to follow for a host of reasons?
I think as a general rule, they do look to the UK. I think post-Brexit, there's been more of a decoupling of that.
Oh, you've used the B
couldn't
word.
get away without putting it in there. But I think they're more independent than they might have been historically. I think we've got a couple of quite interesting things on the horizon. There are elections in a number of European countries, which I think is going to change the dynamics, speed up, slow down M&A. And then globally, the major global election in terms of the United States in November is going to be a very important driver, we believe, in terms of sentiment. Now, generally speaking, presidential election years in the US actually mark out quite decent M&A years historically, but we have the highest count of elections globally by population, over 50% of the world's population, which does have that kind of balancing effect. So we're watching H2 very closely in terms of how the year finishes up.
Certainly over the last 6 months of deal announcements, and I suppose behind closed doors as we work with clients, it's amazing how to date elections haven't really factored in. There hasn't been like a big cliff edge and oh no, we should wait or we should see how this goes. There's been a real bit of momentum through the year and people have just been pushing on.
Yeah, I think markets are very sophisticated. They generally have these things well priced in. And I think people have thought forward in terms of what might the impact be. So that doesn't concern me from a broader perspective. But we're entering the next age for M&A, which is going to be marked by hopefully a stronger 25, building into an even stronger 26, 27. And as we know, M&A is cyclical. One of the things I think we have to be honest to ourselves about is that, while we're seeing very good percentage pickups, 2023 was a very low base. The trend line for me is the average M&A volume 2015 to 2019, so those 5 years pre-COVID. The UK, for example, is still 11% below that average. And those years, they weren't kind of very big M&A years. We've quite a bit to build into yet, and we really look forward, and we're very much positioning the business for growth, and we're trying to capture a higher market share and being there for our clients when they want to get deals done.
I'd love to pick up on themes that both of you have mentioned in your comments, and that's really around the cross-border nature of some of the trends we're observing in the M&A market. James, I think you even used the term picking the family silver in some of your earlier commentary, US or other global companies coming in and acquiring assets in the UK, assets in Ireland that are of very high quality and maybe not as well valued. What are the kinds of themes and trends you're observing with respect to cross-border trends and any regulatory aspects that are top of mind as you observe those trends in action?
Picking up on the regulatory piece. And I know there has been a lot of publicity from a UK perspective, the CMA, our competitions authority, post-Brexit, digging into some of the big global situations. But that's slightly old news. And if anything, they're starting to settle down a little bit. They only have finite resources. They're sort of now starting to develop a little bit more of a predictable pattern. And then our new national security regulations, they've now been enforced for a few years now. So I don't think we see that the regulatory landscape in the UK being an impediment over the next few years. Just on your comment on the dislocation on values and selling high quality UK businesses and why now? There's a couple of lenses to this. I think, as Dwayne mentioned, all strategics have their chessboard. They have their lists. And it's normally just a case of when is there the opportunity? And it's not that the UK markets are wrong. They just have a very glass half empty view of the world to growth and outlook and trajectory. And if you are a strategic buyer and you've got very strong views on how the next 5 years are going to play out, you may be willing to pay for something that, frankly, the UK equity markets are just not valuing. Maybe my biggest worry for the second half is at some point, animal spirits will move from buyers in the boardroom and maybe to the UK equity markets, and we'll see a little bit of a re-rating when that gap will close, and that will maybe make it a little bit tougher for us to get things done.
The UK tends to be the market that is taken over. Do you get a sense that UK companies are going to be more front-footed, doing more M&A outside of the UK, bigger M&A, trying to actually become more of the consolidator on this consolidatee?
It's a good question, and I know it's one we talk about a lot and with our clients. And I think what's really interesting is, we represent about a third of the FTSE 350, so a third of the biggest UK listed companies. And it's across all sectors and it's across all sizes as well. So we've got a real feel for how boards are thinking about this. And you're right. I feel like the UK always has a particularly strict sensitivity to fiduciary duty, which is why big, attractive cash bids will always be taken very, very seriously. And at the end of the day, we're a market. Shareholder value and what shareholder wants very much drives board thinking. But we are starting to see animal spirits build and a lot more outbound appetite. And I think we're going to have a big pivot later in the year. And I know it's been a hot political topic. Even the UK government has been trying to think about how they can make it all a little bit more competitive. And we're seeing some big rule changes that should allow UK companies to really get on the front foot.
Because I think my sense is that we need that to drive the size of the equity market and hopefully kind of build the scale. I always go back to the relative build between the UK as the kind of principal equity market in EMEA and the US equity markets, and the sheer scale differential that has developed in the last 10 years. And I think trying to arrest that a little bit and trying to bulk both UK and EMEA equity markets up through more consolidation and the use of equity, etc., is going to be an interesting theme.
This is an area we've spent a lot of time evaluating and analyzing as well. And maybe just to give the listener some context for some of the points that were just made around valuation around the world, as of when we're recording this, roughly around the middle of 2024, the S&P 500 trades at about a 21 turn PE ratio. That contrasts to about 18 times for the stock 600. That's sort of a pan-European stock index, and just 11 times for the FTSE 100. So just to give you a sense of the relative valuation discrepancy. Now, there's a little bit of a nuance even to the US numbers. A lot of people are now focusing more and more on the equal weighted index that takes into account some of the very, very large companies that we have in the US that are now skewing valuations. The equal weighted index in the S&P 500 trading around 16 times today, but that's still a 5-turn disconnect between even the typical S&P 500 company in the equal weighted index versus the FTSE. That valuation discount definitely has a lot of opportunity to close and potentially really change some of this narrative. I think the other point I would make, and something we've looked at, is the interesting fact that the typical European firm arguably has more financial flexibility on its balance sheet than the typical US firm. So the typical European firm has less leverage and more cash than the typical US firm. And the typical US firm has really taken advantage over the last 15 years of historically low rates in the US, levered up by about sort of one turn on a debt to EBITDA basis. But now the relative financial flexibility between, again, European and US firms, quite different than it has looked historically. So interesting to see where some of those factors take us with respect to the themes and trends around M&A we were just talking about. Maybe with that in mind, as we wrap up today's episode, I'd love to hear from both of you about where you see the M&A market, both in the UK and Ireland, as well as more broadly throughout EMEA.
So look, I think we're feeling really good about the second half. I don't think we see this momentum abating. As is always the case in Europe, there might be a little bit of a pause in announcements over the summer. The key drivers, and I sort of alluded to it earlier, at some point, and it hasn't happened yet, there are a lot of fantastic private sponsor-owned businesses that are ripe for secondary trades. The cohort from sort of 2021 that are now sort of coming into 3 years, there are a number of sponsors that have been preparing hard, but still very much sitting on the fence for that perfect window that we just haven't quite seen yet. If we can get those out into the market, and I think that's going to drive quite a lot of volume, certainly in the UK. As Dwayne said, just an uptick in UK PLC board confidence, just a little bit more strategic outbound M&A. There's a number of ways to build the UK equity market. M&A can do its bit. We can issue shares for buying overseas assets to sort of bulk scale and bulk liquidity too. We're sort of seeing quite a lot of that behind the scenes. Dwayne, what do you reckon from your perspective?
I think the trends will be very similar across EMEA. The momentum, the confidence builds, and actually caught it in a sensible formation. You never want it too quick. You never want it too slow. That's kind of that Goldilocks point. Markets globally are up basically 20 to 25% off the back of last year, which was a low year. The scale deals coming through will remain the key gauge for the general health of the M&A market. That really does require confidence, particularly if you want to do that bigger trade. I think people are getting more comfortable to go out there and, as you said, Evan, there's capacity on balance sheets. And yes, raising debt is more expensive, but let's put that in a historical context.
Can you double click on that?
Debt today is not expensive when you put it into kind of a 20 plus year average. We're going to see the market coming back, and I think coming back strongly. We are gearing up and making sure that we have got the capacity to deal with what we hope will be a wave in the coming years. And we are really thinking about the next cycle, which in our minds is 3, 4, 5, 6 years. I think things will settle down on the political front. Evan, back to one of the factors of the relativeness is that, we have some very serious and very sad conflicts immediately on the European doorstep. Those hopefully coming to settlement will again hopefully build into the confidence. So we're on the positive scale, and we look forward to doing those deals for our clients. We hope it's going to be ever more global, and that's why we have got this real focus on being fully knitted together all the way from Tokyo to New York to Sydney, etc.
And it's good to see the big stuff back, don't you think? Because I know back in 2021, that's maybe like the famous year, the big M&A boom. That's when there was all the transactions. But the reality is, certainly in the UK, it was a very mid-cappy market. There was just a lot of, that sort of $2 to $5 billion range in a short period of time. And the FTSE 100 was actually remarkably quiet. And the big PE was actually remarkably quiet. And that's one of the reasons why the first half this year has exceeded the first half of 2021, is just because we're seeing the big stuff again.
Well, that's right. And frankly, it is actually well spread. It's not in one particular sector, which is a very important test of the health of the market. But the bigger deals define M&A in any one year.
Well, look, this has been great. I really appreciate all the insights into both the UK and Ireland M&A market, as well as the broader EMEA M&A market. I think what we're hearing today is that some of the themes and trends we're seeing, particularly with respect to the pickup in deal activity, really can be thought of as a little bit of a leading indicator for the broader health of the M&A market and transaction trends overall. And that's just very good to hear. Big thanks to James Robinson and Dwayne Lysett for joining me today. Thank you to our listeners for tuning in to another episode of What's the Deal? And we hope you enjoyed the conversation. I'm your host, Evan Junick. Until next time, goodbye.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the investment banking group of JP Morgan Securities LLC and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument.